Testing, 1, 2, 3. Hi there, guys. We have some early attendees, so I'll be back in about, we'll be a little late today if you guys don't mind, okay? So you guys have got some time. So give me another, okay, we've got 10 minutes, maybe about 15 minutes, maybe I'll be about 5 minutes late. Also, if that is okay with you guys, okay? Just got something to sort out just before we start. But you guys have got questions, just put it all onto paper and we shall add it on. We shall go onto it. So, hi you guys. Okay, so it's all loud and clear, Ashwath, yeah? You can see me, I think you can see my screen, myself as well as hear me loud and clear, I guess. Okay, let me just make sure that I've got chargers on. Okay, there we go. So you guys can hear me. I'll be back, but I'll be a little late. Okay, so I'm just going to send a. Okay, just a quick check with you guys. You guys can hear me loud and clear, correct? And see my screen, see myself as well. Everything good to go, and we can start. Everything okay? Yeah. Someone could just reply. Let me know you can hear me and. Loud and clear. We can start. Brilliant. Thank you, Ashraf. Good. All good, Pratap. Thank you. Okay, so we shall start. As I've mentioned, today's topic is the psychological levels basics. It's part 1 of 3. So you've got another 2 more webinars to cover the whole psychological part, but we want to also apply it practically onto trade ideas and signals that I have given as well live as of yesterday. Okay, so all right, Sugu, thank you. Good. So we are starting right now. We want to go through the details of yesterday's trade idea as well. Okay, and that was with GBP crosses, in particular GBP USD. I know I've mentioned about pending orders as well. So here basically is where we want to really apply what we have actually mentioned, and then we want to combine with today's topic, which is regarding psychological levels, because psychological levels in terms of entry price and exit prices are one of the key factor that has actually contributed to consistency of the system, or you can say the methodology that I use for over 5-7 over years. And this is what I have used to apply it. And it's not a technique or a strategy. Actually, it's just an experimented approach into understanding how you can actually enter the market and exit the market, not SL, not the stop loss side of it, but mostly entries and exit prices, the correct or the proper price in order for you to avoid reversals, for example, and also buying and selling at the, I would say, the probable level, the levels that are safer for you to actually enter and exit. Okay, so safer meaning you are most likely being aware of the resistance or the support or any sort of threat of reversals, especially big, huge reversals. Okay, so there you go. Let us take a look at GBP USD. Let me just make sure I have actually recorded it. Okay, good. I am recording it. So, okay. Now we have taken a look at GBP USD. Now I like using the 4-hour chart, as you guys have noticed. And the 4-hour chart gives me better data, but it does not mean that 4-hour chart, if you analyze 4-hour chart, then you need to wait for weeks and months. No, 4-hour chart sometimes, you know, even within a day you can, but if you want to make sure that you are getting pips in within a day, then you can actually always use the 4-hour chart, sorry, let's say on the GBP USD, like what we have used, like what we have actually analyzed on, and then you can go onto smaller time frame to get smaller pips. Okay, so let's take a look at what I've shared as of yesterday in terms of selling, if I'm not mistaken. on the GBP USD because the trend is still to the downside. But let me share with you guys something here that I have sent myself on WhatsApp. Give me a second. It's better for me to share with you guys some screenshots that could actually help you guys. Give me a second. Oh dear, it needs me to do that. Give me a second. Right, give me a second, guys. Yeah. So just sent myself some screenshots of GBP USD, and I think it will help you guys understand better. Okay, so here, for example, we have had, so I can just go onto one slide after another. Okay, so with regards to GBP USD, at the time of analysis, at the time that I have drawn all these lines, I think it was trading in between here. I'm not sure whether we can see it. Yes, we can. 2462, just under 2462, 1.2462. I would say at 2448. Sorry, yeah, 24 under 2462 area, 2460 or something like that at the time. Okay, so but what I've done is I've drawn these four boxes right here. It is very important for us to understand what these boxes are. So what I would like to mention to you guys, because I've given the signal for selling, especially for GBP USD, I want to explain to you a little bit more about why I still stick to the selling. We still have got on the fundamental side, yes, good and bad news in terms of economic data, and we have also got some good news on economic data as well. So and then political situation not very good, and then somehow it went up a little bit more because of what one of the governor have actually said yesterday about trade war with China. First, they said that there were no trades going to go on, and then he changed his speech and he made it. He said that the trade will actually continue. So that impacted London as well, London stocks and all that, because there's a very heavy buying and selling transaction wise between London and the US. Okay, so that caused the GBP USD to jump up a little bit as of yesterday until today in the morning. Okay, so hi there, Calvin, welcome. Okay, any questions you guys can ask at any moment of time. Okay, no worries, but we are talking about GBP USD at the moment because of the trade signals that we have gone through with GBP crosses. I still see a very good chance of GBP crosses volatility. So volatility is good for us to actually make money because we can ride the wave. If there is waves, then we can ride it. If there's no wave, very calm, there's not much movement of pips as well. So hence the reason with volatility comes opportunity, but with opportunity comes risk as well. So we need to balance up between fundamentals and technicals as well. And hence the reason it is really important for us to choose the right price. So the right price of entry and exit could then help you reduce your risk and increase your probability as well. Okay, so excuse me for that. Now here, for example, you guys can see I've got three blue boxes. Now these blue boxes that I've drawn, I would like the prices to go under each one boxes. So that actually means that you see we've got the green lines, two green lines, two purple lines, and two yellow lines, right? So the more the current price has gone under each one line, let's say if it gone under completely all these lines and gone under the two yellow lines as well, then I know that I've got a better likelihood of selling. That means the sellers have actually come in even more. The reason is, remember yesterday we've actually talked a little bit about how if the price is coming down and it needs to come down through previous support. So previously there is a support, and from that support it comes down through that support, then it gives me more clarity that it wants to go down even more. And also it means that there are more and more sellers has actually gone in. But the thing that is really important for us to understand is, you see how I've actually drawn yesterday that look at all these red circles right here. This is a downtrend, for example, right? Now, when it comes down and it goes through and breaks through the previous support, uh, only then it actually signals to us that we have got more selling coming in. So that is why it is really important for us to treat forex when we analyze the market in on the technical side. It's exactly like crossing a very busy highway. When you're actually crossing a very busy highway, what do? You look right and left. So you look right for the current price, and you look at the current price, meaning the current price, how close is it to psychological levels? Very important. Okay, so that's what I do as well. So when I go onto the chart, really important is to look at your current price. You see the current price itself. Let's say we're talking about GBP USD. The current price, when you look to the right, you look for current price. When you look to the left, you're looking at either support or resistance. Okay, so here, for example, when I look at the current price now, when I look to the right, I look at the price and I see that the current price for GBP USD is trading at 1.2495 or 96. So I look at the 96 as the last two digit. Now 96, if 96 goes up to 97, 98 and all that, it'll go to a round number 00. And 00 is one of the major psychological numbers. So 1.2496 will go up and meet 1.2500. So that is actually a psychological level. So what does that actually mean? That means even if you look at current candle, now we are not supposed to look at only one candle or just a single candle that is bullish and bearish. It's actually very risky to do that, and based on that to say that that is a trend. No, what the trend is, the trend at the moment is actually a downtrend. Why? Because it has, number one, it must have, for a downtrend, it must have lower highs and lower lows. You need to remember this: lower highs and lower lows. This is only for downtrend because we're talking about GBP USD. So we want to talk about GBP USD practically on the trend. Now look at this. This is a high. This is another high, right? Now, if you go downwards here, it comes to a low. This is your L, low, and then it goes up, zigzag upwards, and then it corrected itself again, resistant area here. This is your next low. So you've got a low up here, but then you've got a lower low, a lower high. Sorry, you've got a high here, you've got a lower high, right? And then you've got another high that is lower from the next one, and then vice versa. You've got also lower lows. Now you've got this low right here. It came down, the price came down. This is one of the low. The short one here, it went up, came down, and then this is your next low. So this low is, you've got a lower low because this low is lower than that other low. Okay, so low in price meaning just like the valley, and then high in price is like the peak, the very top. So we have got high here, and we've got lower high, and another lower high right now. Okay, then we've got a low here, and then a lower low around this area, and a lower low around here as well. Okay, so this is a nice lower low, this is nice lower low as well, because it's clear to your visual first. Okay, it has to be visually clear, and trust yourself in making that clarity using your eyes. And then what happens is that with practice you'll get better and better. So here you've got a high, and then you've got high, lower high, lower high, lower high. Okay, so maybe I'll discount this one, but I'll take this one as my lower high, and then this one here is still happening. Even if it goes up a little bit more, it's still considered lower than this one, unless it goes up and up and up and up, and it goes beyond this area, then we don't have a lower high anymore. Okay, so right now that trend line hasn't been broken. Okay, got trend line all the way down here. Let's say if I were to draw a line here, let's say if I draw a line at the top all the way down like this. Okay, now notice that I don't draw the line from the wick to the wick. Okay, Now we draw the line wick to the wick only if we draw the geometric pattern. When we draw a trend line like this, it's better from the body to the body, and this would be your upper trend line down. Okay, the other trend line you can actually draw from here all the way down here as well. Okay, just adjust this a little bit. Okay, so now I've got the body there, body there. Okay, some just touch the wick on its own. It's fine. So now we've got this parallel line like this. Now this parallel line that is made up of two lines, two trend line, is called a channel. So we've got a channel down at the moment. Now this channel down may most likely encourage price to go downwards, zigzag, go up towards this trend line here, and make another return downwards. Okay, so zigzag, zigzag, following that whole tube-like channel right here, and that is called a channel down. Okay, so once it actually goes around that area where the yellow line is the upper trend line, most probably we will have a return of price to the downside, and then you will see that it has most likelihood to come downwards towards this trend line right here. Okay, towards this trend line. Okay, and what will most probably happen is that let me just draw this for you. Give me a second. I didn't bring my mouse, so it's a little difficult. Okay, so no problems, we'll just try. So now, for example, let's say it zigzag upwards or however it wants to move, right? And it comes down here. If it does actually breaks out here, most of the time it needs to return to the point of break. And then you have got a better confirmation for it to come down. Because if it doesn't do that, then it might still maintain the zigzag in between. So let me just clarify that again. Let me just clear all drawings here, get rid of that one. Now let me just demonstrate what I've just said again through a drawing first. Okay, so let's say you have got price going up like this, and then it started to come down, and then come down again like this, right? So then what happens is that it may create let's say a channel right here. Okay, creates a channel. Creates a channel there, right? Why? Because it just created a channel there and then it broke out. Okay, so usually it breaks out and it's probably best for it to go back, zigzag upwards. Okay, and then once it does that, then your sell entry is not usually best to sell exactly here once it actually burst out. It is actually to sell once it burst out but gone back there to the same point, and then you can start to actually sell. Okay, so usually it's a nicer, better probability ABCD starting from here. A, then you've got B, C, and then you've got a better D point. And usually what happens if you look to the left as well is that the point of where it goes up may actually be very similar to where it has gone up before in the past to the left. That is why it's really important for us to maintain that left look, right look for psychological levels, and left look for the how you call that support resistance pricing. Prices very significant what do you call that, bounce up or very significant fall of the price. So far you guys are clear? Yeah, because I want to really pay a lot of attention with price action, trend line drawing, and then you want to not mess, but you want to mix that up with psychological numbers as well. Because once you know this approach of psychological numbers with trend line, with visually looking at price action, looking at significant support and resistance, you've already covered the most impactful, effective way of analyzing the market technically. Now, even though it is categorized under technical analysis, but then price action in its own right actually is a big subject matter of its own. And there are a lot of traders until today we're talking about professional traders who literally trade in the millions, managing funds as well, have got no indicators on their chart. they literally trade with support, resistance, and price action. Okay, so I'm going to teach you as we go along with price action, and we mix that up with other ingredients, special ingredients like geometric patterns, psychological numbers, trend line, other type of patterns, harmonic and all that, Elliott wave strategy. Everything else will be an add-on, okay, onto the system that we are building up now together for you guys, for all of you, and that will then be a better approach of trading, because price action is very, very powerful. And if you notice about price action, wherever you go in the education center or academy of any brokers, they will always have topics covered on price action. But the difference between the topic that they actually cover and the topic that I actually cover is that they will never cover the topic onto practical live market as well as a live account with money in it. Okay, it's very rare that they actually do that. Usually, who does that is our trainers who have their independent sites, and trainers from education centers, and not brokers. Okay, so here we are doing things really different, whereby Errante gives me the permission to do that, where I have made that clear that I want to teach and continue my sharing of methodology and strategies and all that using a live account, so that you guys can then see how the live account that has been donated to me can grow for educational purposes, of course, so that you can actually see that that's live money, real, and also real market conditions, so you can then see how you can actually apply. It all takes practice, so don't worry if things are a little bit unclear and you need me to repeat it. We can repeat that on every webinar, because of whatever I have done now to teach you is exactly what I do every day, and I still brush it up every day as well in my own personal trading as well. Okay, so we have got that price action kind of look. Now, with regards to the signal itself, it has actually definitely gone up a little bit more, as I've mentioned, with GBP USD, but I think it didn't trigger the price that we have planned for, which is a good thing, because we sort of tweak the prices based on psychological numbers. If it does actually gets tweaked, and then we have got a bit of a loss because of a big movement in the market, then you can, if you catches the loss early, it's good to actually cut your loss early, as opposed to thinking that, oh, no, I'll just leave it and then later it might come down. No, we don't want to guess the market. Okay, we want to just leave it, clear our mind, and we don't want to have any room as a trader to actually guess what the market could actually do. We don't want any guessing. I have not guessed for a very long time. I have guessed the market a lot in the past and listened to a lot of people, and that's when I made the most loss. So it's probably best for us to always follow the process of analyzing the market. It's probably the best thing for you to do, and the safest, because it then will help you increase your probability and reduce your risk. So now here, back to GBP USD, as you can see, it's very clear. We have got lower highs, correct? We've got a stairs going down. When you got a stairs going down or a wave going down, that means you've got a downtrend. So that downtrend is usually made up of waves, little mini waves inside the big waves, and it's going downwards. Okay, so it goes downwards and then it makes this downward move, and then you have got this upward move, which is a correction, and then downward. But visually, it is really easy for us to look at how it looks like a stairs or a zigzag going down. It also looks like an A here, B here, C here, D here. Okay, so let's go back to, let's just see. Okay, here, for example. So as I have said earlier on, you've got your A here, B here, C here, D here, correct? So when your A to B equals the length of C to D, you've got that potential pattern, and then you can turn that into a geometric pattern. So here we have had a nice fall of price and then a correction, and then look at where the candles have actually reversed. It reversed exactly at where, oops, it reversed exactly at where the D point was projected at, and then now it is actually building that upward type move. But then as it builds up the upward type move, the candles, they sort of get trapped now at the 50, 100 or 200 exponential moving average. So these are the indicators that I use to help you understand, or help us understand, the trend. So I'm only using it as a trend indicator, not for the crosses. You know, some traders ask me about crossing one line, crossing the other line, then you can enter a buy or a sell and all that. I've never used that method or strategy at all. Mainly, I use the indicator only to tell me trend. I enter and exit the market using psychological numbers, as well as the use of patterns that I have drawn. So I wanted you to experiment on this kind of approach and see how well it does for yourself. Okay, that's the most important thing. So if we go on to the next slide, as you can actually see, that ABCD that I've drawn it as such: A here, B here, C here, and D. But look at all these circles that I've drawn, okay? All these circles gives us a channel. If you connect all the dots on one side and connect all the circles on the other side as well, not the dots, the circles, then you will see that it's got a channel to the downside. Now that channel or tube-like formation is telling us that the direction of the trend is to the downside. Okay, so because it is actually moving to the downside, it is seen as more potential to go down even more. Okay, so hence the reason we are expecting this area here to be another resistance to come downwards, and then you can actually draw a fresh new ABCD pattern, starting with A being here, and then B, and then C, and then another leg to the downside towards the D point. Okay, so we're still talking about GBP USD at this moment of time. And if you can, if you guys notice, I've got H here that stands for high, 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 and then L, little L here, L, L, L. This is the lows. So we have got a lower high and a lower low. So downtrend usually equals to lower high, stairs going down, okay, and lower low. The base of the stairs are also going lower and lower compared to the one before it, okay? So then you have got a channel coming down. When you've got a channel coming downwards, then you want to say visually that most likely whatever you are looking at is on a downtrend. So a downtrend does not depend on a single candle, what your friend is saying, no, nothing. It actually has got to do with you and only you to confirm onto the chart by yourself with my guidance. But then you need to trust yourself at the end of the day, okay? So then you want to look at all these one here. If you are educated the right way, you should be able to trust yourself more and more each day, okay? That is the wonder of trading as well, that a lot of people don't see, is that you're actually practicing on yourself to trust yourself even better. Okay, the more you trust yourself with the knowledge that you have learned, the better you will actually be, because you are practicing that much more, and you will end up having a better feeling about what you learn. Because you see, when you're actually learning something, especially in trading, when you learn to trust yourself from the knowledge, the application of the right knowledge, what happens is that you start to have a kind of better feeling of peace with yourself, because you are not doubting yourself. You are not doubting somebody else's method or anything like that. You're just trusting your process of learning and applying whatever you have learned. That is the most important thing, because here in forex trading, it's quite different. It's not like you sit for exams and you've got to read and read and read, and then you'll be asked on what you have read. Here in forex trading, the actual test is actually the test of whether or not your money in your real account is growing or is actually diminishing. That's the only test in forex trading. Okay, so whatever you are doing out there, whether it is a great method that you think you've bought from somewhere or you've learned somewhere for free, whatever that is doesn't actually matter. It is the applicability of it to actually increase the money that you originally have. That is all that matters. And that's the outcome that we all want. Okay, is to grow whatever we have from the beginning and then look at how long more can we actually achieve that. Okay, by analyzing the market properly. So this is where it is really important for us to enjoy what we learn. So here, for example, we have got a very easy concept. You can actually draw your highs like dots like that, and then your lows as well. And then you look at that whole channel. Does that channel look like it's going downwards? If it does, very simple, the trend is on the downside. Then you move on to another time frame. Let's say you started that with 1 hour, and then you go to the 4 hour and you go to the daily. You want to look at whether or not the trend is really down, whether or not you find more and more lower highs and lower lows for a downtrend. Okay, so then let's move on to the next one here. Now, I want to also give you a little bit of an indication of a little education on candlestick. Okay, very simple education on candlestick because it is so important. Where we look at this candle, for example, it's a super candle with a super long wick to the upside. Now, what does it mean when we have a candle that has got a very small body but a very long wick to the upside? If it has got a very long wick like tulang only at the top, that means it doesn't have enough power to go up. Okay, so it is pointing up, but it's telling you that I cannot go up anymore because I do not have energy. I do not have momentum to actually buy and go up more. Okay, that is why I leave you with the bones. Okay, so it's the same thing. If you have got a candle, doesn't matter whether it's a bullish candle or a bearish candle. Okay, if it's got a little body and then you have got a wick to the downside, the wick is the tulang, right? The needle-like feature, and it's very long to the downside. It's much longer, many times over than the body. That tells you that it cannot go down more. So look at it as a finger pointing upwards. The longer the finger means it cannot go to that direction. Okay, so look at all this one here, guys. It's really important. Ladies as well, sorry. Here you have got a wick pointing up. Okay, and look at you always want to look at not only the wick pointing up, how long that wick is compared to the body. The body is smaller, the better, to tell you that that wick, the longer it is, giving you an indication that it cannot go up more, so it is ready to reverse. Okay, so look at all the reversal as well happens. Okay, so here, for example, it went up all the way up here. Okay, and then look at where all the prices have reversed. It has reversed a lot ever since from this level here. Okay, from that level of the wick. So I want you to look at these things as well. These are because the market is filled with a lot of hints, a lot of clues. It's like playing a game where you are looking at clues. You are looking for clues, like a treasure hunt kind of thing. Okay, so the forex market, if you treat it like that, like treasure hunt, whereby you are hunting for clues, and you're hunting for clues so you can put it into your trade plan as sequence, like checklist, that means you are actually a trader investor as opposed to a trader gambler. Okay, so this is where it is highly crucial for you to understand that concept as well. So I think I've finished that slides there. Give me a second, we've got a question. Yes, Ashraf, good question. The wick is long on the top, the price should go down. Yes, correct. If you look at it this way, it's better to think of it as the wick is the bones. When you are left with the bones to the upside, that means it doesn't have energy or momentum to go up. If the wick is pointing downwards, the longer the wick is compared to the body, don't look at only the wick. You need to look at the proportion of the wick compared to the body. If the body is small, the wick is longer to the downside, that means cannot go down more. If the body is small like this, like the one that we have just seen, and then the wick is up there, that means cannot go upwards. That's it. Very simple. Okay, so but if, for example, there's another tip here. If, for example, the best because when we see candlesticks that has a small body and long wick up or long wick down, they are called pin bars. Okay, pin bars, candle patterns, they are a type of pattern that has been used many years, even in stocks, and it is actually applicable in all instruments as well. Every financial instruments, they've got a candlestick chart. You can apply this. Okay, so it shows you exhaustion. It shows you that it cannot actually carry on that trend that it has carried on from before. Okay, so here, for example, I want to give you a little bit of a clue. Okay, so let's say we've got a little candle like this. Yeah. um, and then we have got a wick. Okay, yeah. Okay, right. Then I've also got another one here. Give me a second. Okay, right. Now this is really important, guys, because it is actually happening as we speak right now. Okay, right. Okay, it doesn't matter whether you've got a little wick at the top there, or here at the bottom a little bit, or no wick, or maybe a little bit longer. It doesn't matter. Okay, so as long as you have got a little body with the wick longer than the body, that one single wick up or single wick down has to be longer than the body. Now, let's say I have got the market moving, okay, up, down, up, down, up, down, and then it comes here, and then it has got this right at the very bottom. Okay, and then it goes up, goes up, goes up, goes up, goes up, and then it's here, and then from here it comes down. Okay, so now this is really important, guys. Okay, when you look at a big movement to the downside, like this one is a big downtrend, it just went down, let's say. Okay, forgive my drawing right there. So you've got all these downward type movement, and then it couldn't go down anymore because it had this candle here hinting that it cannot come down more, because we have got a very long wick to the downside and got a very little body. Okay, then it reversed upwards, and as it reverses for some time, went upwards, a very strong uptrend, then we find at the very top, at the peak again, we find that pin bar candle, okay, candlestick, and then it fell down again. So this is just drawing, but let me just show you guys whether or not these things actually really happen. Okay, so here, for example, we have got some element of we've got no pin bar here, but we've got a big type candle. But look at the wick. The wick to the upside is much bigger. So it did actually reverse the market as well. But when you look at areas like this, you have got some pin bar. But again, we want to look at specific type pin bar as well. Okay, so I will show you a strategy that in time to come, for you to combine that with geometric pattern as well. It does actually happen a lot when you look at candles having a pin bar, sorry, the wick upwards higher and quite long, and it's just giving you that indication that market can actually drop. So you want to always look at hints as such. Let's look at GBP AUD. Now we have got no hints of any pin bar. Okay, there's no small body with a very long wick to the downside, telling us that it's coming up. So hence the reason is coming down much more. But look at this one here. Look at this one here. Almost no body. Okay, very long wick, and then it started reversing, and then as it reverses, it went down all the way, and there was a big fall after that. Okay, here, for example, we have got, that's why we are using different techniques, because we cannot really trust just one technique and then look for all these candles with a small body and a long wick, and then it should go up or should this and should do that. We shouldn't do that in trading. In trading, we must not have fixed rule. We have fixed rule for ourselves in terms of a trade plan, what we need to check, but we shouldn't have a fixed rule in terms of the strategy, in terms of not a fixed rule. The rule needs to be strong, yes, but then to actually totally rely on it and think that that is the holy grail and you're only using that, that would actually be very risky. Okay, so there you go. We've got that done. So far, any questions? You guys are okay so far? Because I don't want to give you too many ingredients all at once. I want you to get little and very little, because you will then, you need time to actually practice and apply it, because sometimes the market is such that you may not see it. You may not see what has been taught, and then what happens is that it just may get missed out eventually, and then you'll learn to forget it. Okay, so we want to apply what's applicable at the time. Now, with GBP AUD, I think it has triggered the price now. I mean, I think Noshini has actually asked me whether to close the trade or not. You can actually go back into the trade and resell the GBP AUD. It looks like we have got a good pin bar here. Okay, we've got a good pin bar candlestick pattern here with a small body, and then the wick is to the upside. So it's telling you that it doesn't want to really go up, or it's not capable of going up a lot because of the pin bar right there. It's got exhaustion by the buyers. Okay, so the sellers are taking control at the moment, and I think our price of trigger was at 7940. Why 1.7940? Because 7950 is your psychological level, 7950, right? So you cannot sell at 50. You need to always sell 10 pips below the psychological number. For selling is 10 pips below the psychological number. Okay, now for buying is 10 pips above the psychological number. But let's talk about selling first, because we've got more selling type opportunities for GBP crosses. So here, for example, we have got 7940. Okay, so you guys can enter the trade again. Because I did say you guys can close it as well, but then looks like it's going to our direction, and then we have been hinted with a very nice candle pattern here, a pin bar pattern that I've talked about, and now it's just showing you live that this is what goes on. Okay, and then we have got a very strong, nice bearish candle that has taken price downwards. It has triggered our 7940, and then our take profit price will be at 7830, exactly as what we have shared yesterday. So here, for example, you have got another 96 pips potentially that it can actually drop, sorry. So here, for example, we have got A here, B here, okay, and then you can take that as your C point and downwards. I think we've got questions here. Okay. Tell us more about psychological numbers, says Calvin. How are they helpful? Okay. Yes, of course. We are in the topic of psychological numbers, but I want to show you exactly how it works first. Now, you are using psychological numbers for entries and exits only, not for your stop loss. Okay, but I think you've missed our first introduction to psychological numbers. Before we did one very short one, but today we will go over it again, and I will give you examples of what it is and how you actually adjust your numbers, your prices, current prices, to actually reflect better price to enter and exit. So it's used for your entry and your stop loss, entry and your take profit, not your stop loss. Okay, so here, for example, let us go back and use GBP USD. Okay, no, we could stay on to GBP AUD, let's say. All right, current price at this moment of time is 7921. Okay, current price, let me just type that out. It's only used for currencies, not gold or anything like that. I see it best applicable psychological numbers for entries and exit for currency pairs. Okay, the reason is you don't want to get stopped out easily. You don't want to enter a price where it's just too close to a significant reversal. Okay, this is why we use psychological numbers. So let's say I'll just use a random price first. Okay, so let's say the price is 1.1234. Okay, we want, or if it's 1.12345, you want to take that last digit away, and just keep it at 1.1234 at 4 decimal places. Keep it like that. Okay, so let's say, let me just enlarge that a little bit. Okay, right? So we want to pay attention to the last 2 digit of the price. So the last 2 digit of the price is 34. Now, 34 is not one of the psychological numbers that I trade or I am introducing to you right now. Now, I'm going to be introducing to you 4 sets of psychological numbers. So they are in no sequence at all: 00, okay, 20, 50, and then 80, let's say. Okay, right? The sequence will be in the price itself. That means if 34 goes up and up and up and up, the next psychological number that it will bump into is psychological number 50. Okay, so let me just adjust this one. Okay, so 50 is your psychological number. The next one up. Okay, if the price goes up, but right after that 50, the next one, if price goes up again 1.1 to 50, and then goes to 1.1 to 51, so on and so forth, it will bump into the next psychological number in this list, which is 80, correct? And then so on and so forth. After 80, it will go on to the 00 a number, which is 1.1300, which is again the 00 psychological number, right? Okay, so, and the same way, if market goes down, this one is with market going upwards. Okay, this one is going upwards. There you go. This is if it goes to the upside. There you go. Okay, but what if it goes to the downside? If prices were to go to the downside like that, okay, here for example, and okay, now if it goes down to the downside, 34, you guys can tell me, if 34 were to drop in price, which psychological number will it first bump into, following the list of psychological numbers right here? Which one? Because we make it a nice guess. Good. Yes, you guys typed it first. Well done, Kelvin. Brilliant. So there you go. So if it goes to 20, and then the next one, it would actually meet the 00, which is 1.1100, correct? So 1.1100 like that. Okay. Sorry, 1.1200. Sorry. There you go. So that's a 00 psychological number, and so on and so forth. So this is how we want to look at the price. So if we want to look at these and apply, bridge the gap between what we see now as theory to the practicality of it, it's very easy. We just want to look at what is the price. Hence the reason it is so important for us to always be on an alert when we're looking into the market through a chart, whether it's a candlestick chart or anything else. We still want to maintain that visual alertness of looking to your right and looking to your left. This is the most important thing. So when I look to the right, I'm looking at the play of price action, but most importantly, where is it in between which psychological number to the upside and to the downside? This is the most important thing. So for example, now we're looking at GBP AUD, and the price now is at 1.7924. 24, very easy. If 24 drops downwards, it may actually reverse at the 20 psychological number. These are what the psychological numbers are telling you as well. That actually means that we are too close to the number 20 psychological number, and it is best for us to only sell if we want to sell once price goes under the 20. So not now. So what traders usually do is that they look at the candle and they look at the trend and they say, wow, I think I would like to sell because the trend is to the downside. I've drawn this and I've drawn that, and I think I will sell right now. Now, the thing about price action is that it's hinting you that no, you shouldn't be actually selling now, because it could potentially reverse very close to the 1.7920 psychological number. So it's also telling you that it's not a nice ideal price to enter your sell. When do you enter your sell? You enter your sell at a proper pricing of under the psychological number, at least by 10 pips. So the closest psychological number is 1.7920, 20. So if you want to sell, you need to sell below 20, 10 pips below 20. So 20 minus 10 is 10. So the ideal better price to sell is at 1.7910. Not now, not when it reaches 1.7920 or anywhere close to 7920. It's better if it is at 1.7910 and below. Okay, but of course you guys will ask me, if it is 1.7910, what happens? 10 pips under it will be the next psychological number of 00, okay, which is 7900. Well, you just need to be alert and adjust it only once, the closest one to the price that you're looking at. Okay, but of course we've got other ingredients that I will teach you in order for you to add it on to the psychological number. So the psychological numbers itself is not the only strategy. So try not to get too caught up with one strategy, one approach, and think that you have to perfect it so much. No, you just have to treat it like cooking. When you cook, you will have ingredients on the side. You will actually have your garlic, your ginger, your onions, let's say chili, for example. All that needs to be put at the very beginning of cooking. It's very rare that we put all these ingredients at the end of cooking once the meat is cooked, right? So we don't do all these things. So it's the same in analyzing the market. What you need to do is first discover the trend, understand the trend using the exponential moving averages. So that's your first stage. And then you want to look at it even visually as well, looking at many lower highs and lower lows so that you get a bit of an idea that it is on a downtrend. GBP AUD on a 4-hour chart, as you zoom out, is very, very simple. You can see that most of the candles are trading, are moving, like current price now as well, and all these candles here, they are under all these three blue lines. Ignore the yellow line and the red line for now and look at only the blue lines. The blue lines are the exponential moving average of 200, 100 and 50. When the candles are under all three lines, the current price and majority of the candles are under all these three lines, that means it's favoring the downward move. It's favoring downtrend. And then together with that, you add up another ingredient, which is looking at it visually, and you can still see that it has lower highs and lower lows. And this confirms it that it is on a downtrend on the 4-hour chart. Once you are on the 4-hour chart and you see these elements, you see these ingredients, and you see that the trend is on a downtrend, you want to then go on to the daily chart, all the 1-hour chart as well, all three time frames, to make sure that you see the same thing in all three time frames. When you see the same thing in all three time frames, that means your trend is quite solid of whatever you are actually looking at in all three time frames. Does that make sense, you guys? Okay, so far? Okay, so let's do another practice. Look into the daily chart right here. On the daily chart, look at the trend itself. I can see that the current candles are under all the three lines. The three lines are not really very smooth. They're not very nice visually. Why? Because when I see the three candles entangled, they are not a good sign of the trend. They need to be very, very smooth to the downside. They need to actually be, how do you call that? They need to be separated with one another like that and going downwards. That is when you have all the candles under all the three lines, and that is when it is giving you hints that the trend is quite clear. Okay, so if I go, if we were to look at it in the 1-hour chart, let me just, okay, you can see that it is quite smooth downward move of all three lines not touching one another on the 1-hour chart. Then you've got all the candles, most of the candles, current prices as well, under all the three lines. So yes, on the 1-hour chart, the downtrend is quite strong. Okay, and then you want to look at the price on the right. When we see on the right 1.7928, we know that, okay, it's at 28. As it goes down, it goes to 20. I need it to gain more momentum of the bearishness once it reaches 20 and below, because I would like to sell it, but I wouldn't want to sell it now. I would I would prefer to sell it once it goes towards 20 and under 20 by 10 pips, then I can enter a sell. Now, the other thing as well is when you're looking at the potential of selling. Now we're talking about GBP AUD. When you're looking at selling, you're looking at all these candles going down, you're looking at prices falling. Don't get overexcited with thinking that this is what's going to happen. You need to also think about what could potentially happen is a reversal. Why? Because now we are at 7929. 7929, as it goes downwards, it might reverse at 7920 area, correct? But then we need to also look to the left as though we are crossing a very busy highway. So you want to look to the left as well. You want to zoom out, maybe use the 4-hour chart. You want to zoom out a little bit and you want to scroll. Following the current price now, you want to scroll towards the left and you want to see whether or not in the past were there any significant support, because we are looking at price falling, but then where could it actually reverse, may actually mirror the reversal in the past, okay, to the left. So we will get to that in a minute. Let me just check your questions. Okay. Hi there, Calvin. Um, Calvin says, let me take you back a little bit in psychological levels. Sure. 10 pips below any psychological levels is quite a short distance. Should we, as a result, wait for the candle to close? No, it's not necessary. You just look for the next psychological level, and you're not looking at the next psychological level and the next psychological level. No. Let's say now I would like to sell. Okay, price is very close to 7950, so I obviously don't want to sell at 7950 or anywhere close. I want to sell at 10 pips under the 50, which is 7940, and I just sell it there. I don't actually look at the next psychological number to exit and all that. No, because we are not exiting, we are entering and exiting using the psychological numbers, but we are not using the next psychological numbers and the next psychological numbers. We are not scalping here. We are using psychological numbers as a tool, but I will be using the geometric patterns and other strategies to actually give you bigger pips and bigger distances. So no, we are not using psychological numbers to gain in between the lines, in between 00 and 80. That is where we exit. No, we're not using it like that. Okay, so now I'm just making you understand what psychological levels are and how do you actually adjust the numbers, the price, accordingly to whether it is a sell order or a buy order. When you want to buy, you buy above the closest psychological number. That would be an ideal, better price to enter the market. I'll give you a bit of an example. Okay, the reason why we actually use that, use psychological numbers, or us, especially our community here, because we don't get that to a large extent, traders out there using psychological numbers, because it's not very common. It's something that I have found out myself through experimentation and tweaked other trainers from long time ago, but then I use it specifically for forex trading. Some others are using round numbers and all that for stocks or equities and all that. It's very different. So I've sort of used these 4 sets of psychological numbers only for forex. Okay, and I've picked only 4, which are the 00, the 20, the 80, and the 50. Okay, so here, for example, let's say we have got price fell from there all the way down, correct? So what we do is, let's look at where the reversal has actually happened. We can actually look at the lowest body, mark a line on the lowest body. It gives us the price 1.9624. So 24 is only 4 pips away from 20 psychological level, hence the reason it reversed from there. And then if we were to look at the lowest wick as well here, look at where it points out. It pointed out to 1.9515. 15 or 15 is only 5 pips away from 20, from the 20 psychological number. Okay, so let's look at this reversal here, this big reversal where it went up and then at the peak it came down. Let's look at the body where it reversed, the highest body that I can actually see right there. Okay, that pointed out at 2.0563, not quite at the psychological level, because it happens about 90% of the time, but not 100% of the time. But then we can always look at the wick. So the wick was at 2.0594. So 94 is only 6 pips away from the 00 psychological number. So there you go. You've got some indication here. You guys can go ahead and experiment that as much as possible as well, because I've experimented that, I think, with about 8,000 charts with a software to actually look at how much has the market reversed in these four psychological levels. So that gave me a statistics of about 87.88% of the time for currencies especially, and we have looked at it in all the currencies, currency pair possible. Okay, so let's look at this. Okay, how do we determine the stop loss? Okay, stop loss is actually really easy. Stop loss, we use the ratio of 1 to 1. What that means is that you find out your entry price, you turn the entry price from psychological numbers, you found your entry price, right? And then you've got your take profit as well. Now, when you have your entry price and your take profit, you have your potential number of pips that you could actually win, correct? So you've got your potential pips, winning pips. Let's say it's 50 pips. So if it is 50 pips, then you want to maintain that for your stop loss as well. That means the distance between your entry to your stop loss will also be 50 pips if your entry to your take profit is 50 pips. That is what is called the 1 to 1 risk to reward ratio. So you don't need to do any calculation or tweaking the price for your stop loss. Your stop loss is almost automatic. Once you know your entry and your take profit, you just know the number of pips, potential winning pips will equal potential losing pips as well. So that is your risk to reward of 1 to 1. Okay, does that make sense, Nashini? It's okay for you? Brilliant, good. So that's it. We want to keep it really, really simple as well. But then, of course, it doesn't mean that if you are already winning and you want to maintain your stop loss there, just leave it there. No, you can actually move your stop loss closer to your entry so that your stop loss gets less and less as well as your winning goes up. So you can always adjust. You can go onto your trade, right click, you can modify your order and you can change your stop loss. But we want to do this as we progress. Okay, so we want to be clear in what we do, because there's a lot of techniques and approach in the money management side of it, in the technical analysis side of it, in choosing the right pair. So there's a lot of strategies and approaches that actually works. So sometimes we tend to get overwhelmed with all these strategies to put it all at once. You cannot do that. So you need time as well. So don't worry if it is something that we have not covered now. We will definitely cover it in as we go along. Okay. Okay, Kelvin's question is, when drawing the ABCD while still using those EMAs, where should point A be? Very good question. Now, the EMAs are separate reasons for the ABCD pattern or the geometric pattern. The EMAs are used just to tell you whether it is a downtrend or an uptrend. Why? Because you need to know the trend before drawing the right pattern. The right pattern has to match the current trend. Okay, so if it is a downtrend, with all the candles under all the three lines, you are only looking for bearish ABCD. Okay, so bearish ABCD only in bearish market. Bullish ABCD going up is only in a bullish market. Okay, so here, for example, I would be looking at bearish ABCD. Bearish ABCD means all these A here, B here, C here, D coming down. A here, B here, C here, D coming down. So then, for example, I've got a one coming up right now where I could potentially draw an A from here all the way down here. Let me enlarge that a little bit. Okay, hope you guys can see that. Okay, so we've got A to B, let's say, right? And then it goes up there to the C. So we have got a C pattern right there. Now, visually, it doesn't look really very nice. Okay, sometimes this is the magic of geometric patterns, is that sometimes visually it looks nicer with a lot of the rules being ticked, the better and higher probability it would be. The reason that makes it nice or not really visually attractive is the broadness of the B to C. The B to C should actually be not more than about 70% of the length of the A to B. You see the A to B here. If it is more than about 70%, it looks really weird. If it is kept at the 61.8%, it's quite nice. Okay, but sometimes we have got magic ratios as well in Fibonacci. We use the 78.6 Fibonacci ratio and the 61.8, but I need to cover that at a later stage because this is more an advanced technique, but we'll take that step by step. So here, for example, if I've got A here, or your A could actually be here as well, or your A can actually be here as well. Now, how do we know where the A point is, which is exactly the question that we just got just now. Now, who determines where your AB is actually Mr. Fibonacci himself? Okay, your tool, your Fibonacci tool. Your Fibonacci tool need to be pulled from the A point to the B point to look at where the C point lands. That actually means that your A point to your B point needs to find the C point at a minimum of 38.2%. Okay, so let me just clarify that. So I have got A here, B here. Okay, and then from B I'm drawing a line upwards. So I've got, let's say, A market drop to the B point, B rises upwards to the C point. This is your C point. The C point is really very important in the ABCD drawing, okay, of your geometric pattern. Now, if, oops, okay, oh, it went somewhere else. Okay, give me a second. All right, so let's say if I've got A to B, just adjust this a little bit and let that go up here. Got more space to draw. So I've got A to B, A to B, B to C, let's say, right? And then I want to predict how far could it actually fall. So my AB equals C to D here, for example, okay? So we have got, right? You've got your A to B here, B to C. You can always use your copy paste as well. I just got so used in redrawing it that I sometimes forgotten that I can use the copy paste. So here, for example, A, B, B to C, and your D is somewhere down here, correct? Now, this pattern is a bearish ABCD, geometric ABCD pattern that's supposed to be, should only be found in a bearish market. Okay, so here, for example, my C point, why did I pull my A from here is when, if I have my A pull down to my B, I need the C point to be a minimum of 38.2. Only then I will proceed further in trading this pattern. If, for example, I have pulled my A point to the B point and the C does not actually reach 38.2%, then I will not consider this pattern. So where, to answer your question, where should your A be? Your A could actually be at any peak, so as long as the C point is at the minimum of 38.2. So for example, let's say if I pull my, let's say A could actually be here, A could actually be here, my B is here, and my C is there, right? So let's see if I've chosen this wick right here as my A, and I pull it down to my B here, I look at my C, it's not bad. It's at 61.8 roughly, right? Which is good. But let's say if I've chosen my A to be right at the very top here, okay, A, I pull down to the B, and look at my C point has not even touched any of the levels in yellow here, and it's not a minimum 38.2, didn't touch the lines at all, then I cannot make my A point here. I need to then pull it down and pull it down until it touches a minimum 38.2. So my A could actually be here, but not up and further up. Okay, hopefully that makes sense. But don't worry about it, because we will run the webinar series on Fibonacci ratio together with a pattern, because all that is actually quite advanced. So we are not very far behind, because we've not even started that yet. So don't worry about it. When we go into Fibonacci and patterns, I will tell you about the retracement level ratios that I use, and how do you actually pick a pattern that is high probability as well. Okay, so let's leave Fibonacci aside. Let's go back to the psychological levels, because these are very, very important areas that would be under the subject of price action, but then to ideally choose a higher probable price of entry and exit. Okay, so here let's go back. Let's look at GBP CAD. Have you guys got any questions so far? You guys okay? Yeah, so far your question there, Calvin, is it okay? Did I answer your question, and did you get that for drawing your A point? Brilliant. Okay, good. So we have got, let's see, GBP CAD, GBP CAD on the 4-hour chart. At the moment, this currency pair is trading at 1.6870. Okay, so 70. Most importantly, we need to know the trend. Trend wise, it looks like we still have got lower highs. We also have lower lows. Okay, I would love for more movement to downside, so that it goes lower than this area here, and it goes lower as well, and it gives us more power to the downside. So let's say if I have compared it to the 1-hour chart and the 4-hour chart and the daily chart as well, and I find this to be a downtrend. So downtrend gives me a potential of an ABCD pattern pointing downwards, but also downtrend means that if I were to actually sell following the psychological numbers, I should be selling 10 pips under the psychological level. So let's say I would like to sell. What is the ideal price? First step is to look at which psychological number is closest to the directional movement of the current price. Current price is moving downwards, and as it moves downwards, dropping in price, 1.6869 is the current price. As 69 goes down to 68, 65, 60, so on and so forth, it will first bump into the 1.6850 psychological number. So as it reaches 1.6850, that points us to a potential area where price can actually reverse as well. So we don't want to sell very close to the 50. So 50 is your psychological level. Now, if you were to sell, you need to sell 10 pips under the 50, which gives you 40, correct? So 1.6840 would be a better price to sell, not now. So let us just get rid of all these lines right here. Okay. And let us mark one line above the current price based on psychological number, and another line based on the one under psychological number under the current price, and one above the current price. Now, if price were to go up, of course, it will reach the 68.80, because now the price is only at 1.6873, so it could potentially reach 1.6880 if it moves upwards, right? So we have got 68.80 as your psychological number to the upside. Now, because it's just so close, the next psychological up is 6900, correct? So you can also put that on 6900 as your psychological level. Okay. What that means is that if prices were to pierce through these two lines and going up and up, then you've got a higher potential for prices to go upwards. Okay. But then as it falls, it will meet the 6850 psychological level. 68, oh, sorry, 50. There you go. So maybe I'll get rid of the 6880 because it's just too close. Oops, that mistake. 6850. Second, 50. Okay, so now you have got the current price having one psychological number above it, which is 1.6900, and also one under it, which is the 6850. So but what that actually means is that the current price now is trapped between two closest psychological number. We'll ignore the 68.80. We'll take the 6900 just so that the current price is in the middle of these two lines. Okay, so that means it's trapped, sandwiched in between these two psychological levels. So what does that mean? That actually means that if we want to look at further fall of price, it needs to break under this lower psychological level. Okay, and perhaps wait till it goes back up to the area of where it has broken out, then you have got the potential to the upside, to the downside, sorry. Okay, and that will then give us more confidence once it actually breaks out from this area again after it has revisited the area where it has broken out from, and then it starts to fall. Then you've got a nice sell entry here. Okay, then you can actually look at A from here, B, C, and then C to D to the downside. Okay, and similarly, if it does actually break outwards, upwards from 6900, then you're looking at it coming back again, and then this is your point of entry. Roughly, you need to adjust that psychological number as well before it goes back up, back upwards. Okay, does that make sense? You guys are okay, clear? As we go on, you've got loads and loads of ingredients that we're going to put in, a lot of things that I have noticed, and through experience I will share that with you, and you are putting all that into your bag of tools to actually trade the market. Okay, good. So far so good, guys. You guys are all clear. Any question from Sugu's side? Any questions? No question. Sugu's team all okay? The rest of you guys as well, feel free to ask if you got any questions. All good? Okay. All right, guys. I think it's probably best for us to get questions, and any questions needs to be clarified so that things are good. No, Shini, good. Okay, everything's fine. Brilliant. Good. Okay, guys. Maybe it's probably best for questions to come up. If you guys have got questions before we end the session, tomorrow is another day and another session. All good? No questions? You guys gone quiet on me again? Questions? All right. Good. Calvin, how does one know that the market has reversed and should swallow the losses? You've got many ways in knowing that. I mean, you've got the technical side of it. As I've mentioned, we've got a pin bar, candlestick pin bar as one of the reversal pattern. We've also got indicator like the stochastic that you can actually look at. What do you call it? Divergence. Divergence meaning when you look at one indicator and it doesn't actually match the movement of candlesticks as well. So there are many that we can actually look at, but it's probably best for us to dedicate a specific webinar for a specific style of knowing about resistance or using a particular indicator. But the psychological numbers are also a very good indicator of how prices could potentially reverse, and hence it's probably not the best price to actually enter or exit. Now, when you exit as well, you need to exit before the psychological number. Okay, the strongest round number, to be very honest, it does actually change a lot, but the major ones are the 00 and 50. But you know, you are probably the best to actually do that experiment and look at a currency pair, for example. And give me a second. Let's say a currency pair like this, and we have got, let's say GBP CAD, right, on a 4-hour chart. We have got a big reversal here. We've got a big fall after it reversed there. So we can always just look at the body of the price, 1.7624 or 25, and it is very close to the 20 psychological numbers. And if we look into the wick, for example, it reversed at 1.7705, which is only 5 pips away from the 00 psychological number. So the think about reversal using psychological numbers as well, or the major ones, it does actually differ from different pairs. So big movements I've noticed for JPY crosses are usually at the 80 and the 50, for example. And then we've got GBP crosses, and GBP crosses, depending on the crosses itself, has got its favorite psychological number to reverse on a large scale at 20 and 00. So this is basically what I meant by being able for yourself to actually look into it by experimenting and looking at certain pairs that you trade and look back at major reversals, and you can actually do a log and manually log into all these big reversals, which one reversed at which psychological numbers most. Okay, so here GBP CAD, again, look at this very big reversal at the body of the candle, the highest body of the candle at 7921, and that is again very close to 20 psychological numbers. As far as I know, for GBP crosses, its favorite is big reversals. Favorite are at the 20 and 00, and with this one on the wick is at 80.55. So that's the 50 psychological level. So if you look at the body as well, here, reversal of the body area, it is again 6630, 10 pips above the 20 psychological level. But if we look at the wick area, 6540. So there's just no sets, and sometimes I think it does actually changes as well. I don't think that is the criteria that we need to look at, but we just need to maintain that 4 sets of psychological numbers for entries and exit. Whichever that happens the most doesn't really matter, because what matters is you choosing the right price for entry and exit for you to avoid or miss the reversal. That is the most important thing. Like, for example, we have had GBP USD, GBP AUD as our trade signal, and we did actually, use psychological levels. It may not happen 100% of the time, but over 88, 80 plus percent of the time that we can actually see that and rely on psychological numbers for entries and exits. And I've been using it for the past almost 10 years. I never failed to tweak the numbers based on psychological numbers. So it has been worked really well for myself and my community of traders. And I think it's probably best for you to experiment doing that and see if it does actually help you. Then why not put that as one of the tools in your bag of tricks? Okay. All right, there you go. Also, we want to look into drawing trend lines, drawing triangles, patterns, triangles, so that you get an idea of how the price are actually moving. So here, for example, from body to body right here, we can tell that GBP USD is actually moving in this constricted area triangle right now, and hasn't actually broke out above or below that triangle formation yet. So it's more likely going to go zigzag, zigzag, and then break out at closer to this area right here. Okay, for GBP USD. Okay, AUD JPY. Let's take a look together, Pratap, on AUD. Is that a? Oh, wait, let me just see whether I've probably forgotten it. AUD JPY. Yes, of course. We can take a look at that, Pratap. No problem. AUD JPY. We have got reversals happening, but then I look at the potential of still on the sell side, and of course, you know, it has gone beyond a little bit, but then now it's beginning to reverse again to the downside. So I think it has the potential to still follow this giant purple pattern, but it is consolidating at this moment of time. We would like to see how it respects the 73.80 psychological level. Does it actually look at it as a reversal level, or will it actually go under the 80? If it does actually go under 73.80, that actually means that it's gone back to track, back on track onto the downside move for the AUD JPY. The only reason is because we had the PMI figures, we have got all this manufacturing data of Australia that somehow magically became really positive. But then, you know, we had Chinese figures as well positive. So you see there's a big correlation between Australia's data and Chinese data, because they are a very, very close trading partners as well. So I think the market went up, you know, pushed the prices upwards, appreciated a little bit more, just as a reaction on the positive data from Australia's PMI, Purchasing Manufacturing Index. And that is why. But then as you look at it here, for example, it is beginning to reverse. It's got all these, what do you call that, play of a downward type movement. But we need to make sure that it is to the downside after it goes under the 73.80 and going downwards to 73.70. Then you can see it another sell there, 73.70, and then take profit around there as well. Once it has actually then gone under 72.50 and under, then it is actually on its second round of profit right here. But now, yes, it is looking like it's a little bit too early, but look at where it has actually reversed. What is the price that it has reversed on the body? On the body itself, it reversed at the 74.27, which is close to 20 psychological number. On the wick, 74.41 or 42, which is very close to the 50 psychological level. So there you go. It has reversed in both psychological areas, so psychological levels or numbers. So I think the likelihood of it is for the price to actually come down. But looking at the price now at 73.93, we need to just go to the left and look at whether or not on the current price, has it got a bearish, single bearish candle in the past on that price itself. So here I see that, but it's a very small one there. I'm just on the lookout to see bigger ones. We've got some there, but then it's got not much as well from the area. We've got one, not yet, sorry. We've got one here, not really that promising, but we've got one longer one here and the one here, which is okay, not too bad. From there right down to here, we've got about 20 pips, not that impressive, because we're looking at the 1 hour chart. We've got one here as well, not very impressive, not like a big single mother candle. You know, this is what we're looking at. This is about only 16 pips. Let's look at it. Oh, we've got one longer one here, and from there right to the end, not too bad, about 93 pips. That's a good one. So that's one to look out for. Okay. I'll mark that from the top purple line, end of the candle. Okay. So there you go. And as we look at it, so we have got candle there 74, so 74.10 you could actually sell at 74.10 and take profit at 73.10. Okay, 74.10, 73.10. Okay, so about 100 pips there. So you can see that the momentum is actually building up as well, going upwards, going downwards, sorry. And this could potentially be, but I would prefer to look at how much it would actually pass or surpass 73.80 to the downside. If it does actually reach 73.70, then our likelihood or the likelihood for it and the probability would be actually much higher to actually go downwards. Hope that answers your question, Pratap. It's okay. AUDJPY, that is, yeah. Okay. So yeah, I think yes, it has reacted to the markets, but overall trend, I believe it is still to the downside. Let me just see. Not sure why the 3 EMAs didn't really appear here. Okay, perhaps better for me to upload it. Yeah. Okay. AUDJPY on the 4 hour. Yeah, it's a little unpredictable here, but then we've got potential still on the 4 hour, on the lower time frames too, as well as the 4 hour. But at this moment of time, it still is a potential for it to look into the current areas. It's just that the governor of the bank as well is not really looking at lowering the rates at this moment of time, and it has some connection with GBP. So how GBP actually moves with the current governor's call of not reducing interest rate means that it wants to pick the price upwards and not to reduce or depreciate the rates at this moment of time. Okay. Okay, there you go, guys. Hope that makes sense, and we can always communicate via Telegram for any information that you need or questions to be answered. You can always ask me on Telegram directly, no problems. Okay. All right, guys. Any more questions? You guys are okay? All right, no worries. Thank you. Okay, so we will have much more to talk about. Tomorrow is Thursday. It's not Thursday, sorry, it's Wednesday. And it's already midweek tomorrow, so we will look into more pairs to talk about. I was looking at USD CHF, and most probably we'll have that posted on Trading Dot and send you guys the link. Okay, good. Appreciate that, Pratap. Thank you very much. Okay, guys, I think for now we will leave that to tomorrow's. So we are conducting this webinar every day now, yeah, for our fellow Malaysians, especially because of the timing, and it might not fit majority of people in Africa or other parts of the world or even in Europe. But then for those who can make it, are most welcome to actually join in. But we will have different webinars for different markets as well, different regions, different countries. So the one on Thursdays and Friday that I do on at 7 p.m. Cyprus time, that's mainly catered for our fellow Africans traders out there. Okay, so this is where I want to set it up according to regions as well. But we will have the webinars happening much more frequent, of course, with you guys participating and showing your commitment of wanting to spread the words around and get more friends in as well. As it grows, then we will have much more webinars as well. But I like to conduct those live webinars as well as tutorial type webinars so that we teach you some days we teach you certain strategies, and some days we talk about the market, and most days we talk about the market live and show you what are the potential trading opportunities. Okay. All right, guys. Once again, thank you very much. And this recording will be available, and you guys are most welcome. And you guys, we will meet again tomorrow, same time. Okay. Take care, guys. Thank you very much. Bye bye for now.